Okay, so the Federal Reserve met today and they did exactly what the market expected, which was to lower the Federal Reserve rate. And I'm making this video because I need to remind everybody that when the Fed cuts interest rates on the Federal Reserve rate, that is very short-term timing, okay? Those are what banks trade money back and forth on an overnight basis. So it's a very short-term loan. Think about it like that. What mortgage rates follow, once again, is the 10-year Treasury note. And what I want to show you actually is a historical the last several cuts and what happened to the 10-year Treasury. All right, so what's actually happened back in December of 24, the Federal Reserve cut the interest rates for the Federal Reserve rate, and the rates actually went up on the 10-year Treasury by 0.07% the following day. Back in September of this year, they started off at 4.04, and after the Fed rate cut, they went to 4.11. And then back in October 29th, when they did that cut, it was at 4.06 and now went to 4.10. And it actually happened again today when they lowered the rates. The rates actually on the 10-year Treasury went up, meaning that the mortgage rates went up. Okay, so not much, I mean, barely noticeable, but basically flat. And so what everybody needs to understand is it's all about expectations, market expectations. So right now, what the market's concerned with is if they cut the rates too quickly, that inflation is going to spike again, and then they're going to go back and raise rates or do quantitative tightening or something along those lines. So at the moment, right now, the federal rate cut that just happened today actually caused rates to go up slightly, about 0.05, about 5 or 6 basis points. All right, so just keep that in mind. And if you're a home seller, there's more reason for you to actually take heed a little bit, because it's all about affordability right now. They want to bring the home prices down because they feel they're out of touch with reality. And how are they going to do that? They're going to keep rates high in order to force prices down. And so it might not be what everybody wants to hear, but that's what's going on at this very moment. We could see some quantitative easing where they actually start to buy up mortgage-backed securities. That would actually make a big difference to the interest rate. And we expect to possibly see that as early as Q1 of next year. But as of right now, this is what we got going on, guys. So happy Merry Christmas, Happy New Year's. Hope everybody's doing good. And if you have any questions, give me a call. Have a great day. Bye.